Okay, folks, welcome to Sunday Night Futures Live. Sorry I'm late. No technical difficulties. I did not forget to turn on my camera. I just am late, very late. So my apologies. And what a day, huh? What a day. So NVDA, it tops $2.5 trillion in market cap. And the stock market took a dive. That is what we're going to be talking about today. Really macro stuff. This was a broad-based bloodbath. Energy, industrials, XGE, healthcare. The breakdown on the consumer sector was unbelievable. The chart of the XLY last night looked beautiful for a breakout. Today, it looks like trash. We're going to be going over all these charts in a moment. The question is, what's going on? What really happened today? So, we need to begin with where we left off on Sunday night. For those that are new, we do these live streams what's with this background? I'm going to try to fix this background. I'm fading in and out. I'm not even watching and it's driving me nuts. How do I fix this? Every Thursday night, and there we go. That's better. And Sunday night. And on Sunday night, I said, be careful. We're going to go over it again in a moment. Be careful. It looks as though equities want to go up. That, however, we are on very, very thin ice. We have no volume, no up volume, and equities are extremely overvalued as measured by the Buffett method, the Buffett stock market, the GDP metric. We're going to go over that in a moment. So be careful here. We have the Fed minutes coming up this week. We had NVIDIA earnings coming up. These are all catalysts that could send the markets tumbling. In particular, NVIDIA is kind of like the back end of earnings season. And despite the fact that yields have been pressing up higher, the markets have been shrugging it off for the most part. Today, it couldn't do it anymore. We're gonna take a look at the dollar. The dollar's move today absolutely annihilated the technically it began earlier in the week, the commodity space. So it wasn't just today. Today was like the cherry on the cake. So the question is, why are yields rising and why is the US dollar continuing to press up higher with inflation? Doesn't make sense, right? Let's talk about it. So yesterday we had the Federal Reserve minutes that were released for last month. I don't pay all that much attention to it. It's old data. I think that it's probably groomed, trimmed, sculpted to help fit the narrative of the day a couple of weeks later. And I kind of ignore it. So the tone out of the Federal Reserve was that they were hawkish. There were members that were voting for interest rate hikes. And I've been saying all along, it's nuts to cut. It's nuts. Again, I'm going to go down this road for the benefit of those that have not watched before or have not heard. How do you take the GDP read out of the Atlanta Federal Reserve, which is supposed to come in at over 4%, add to that, inflation still hot. How do you cut rates and why? Why would you do that? All you're going to do is make inflation hotter. So last night, when I took a look at the CME Fed Watch tool after the Fed minutes, it was down a little bit. And when I put out market wrap for members, I said, be careful here. If we drop down, we've been slowly declining in the probability of a rate cut for September. if we drop down into the 50s, get worried about this market, because all of a sudden that rate cut that was a guarantee in September, now it's jump ball. It's 50-50, coin flip. So what happened today? We went into the day with a probability of an ease of about 61%. Now, 52%, a 10% drop in a probability in one day. This is probably going to continue to decline. So take September and in all probability, cross it off the list of a date where we'll see a rate cut. There is no meeting in October. That brings us to November. We're just going into we're going into the summer now. We're talking about November, where they still have a probability of only 63%. This was above 80 a couple of days ago. You want to know why the market's buckling? Look no further. This is a market that is a heroin addict, and it needs its fix. And its fix is free money, cheap money. And they've been willing to sit with the ease, no tightening, no more rate hikes. But now all of a sudden, you have Fed governors out there not talking about rate cuts. They're talking about rate hikes. Think about it. What does that do for the markets? The markets are built, pure and simple, on hopium. They don't trade on fact. They trade on hope. The Federal Reserve, again, another metaphor. The U.S. Wall Street is a drunk at a party that doesn't know what time to go home, and they're looking for more punch out of the punch bowl. So that's pretty much where we're at in a nutshell. And the rug is being pulled out from underneath us. Now, looking at December, I have not looked at this. December is still, so I've been saying all along, if they're going to do it in 2024, it's going to happen in December. Looks like that's probably going to be the case. But by then, I think that you're going to see this economy probably in free fall. So I'm going to go over why in a moment. So let's say hello to folks. Please tell me my audio is working. Usually when I don't check the audio, the chat comments first, my audio is not working. I would have been talking for now. I was late, so about 8 minutes. So that would have been very, very humiliating. And I'm glad it worked. And look at Talon out there checking the audio for me. I would have had that. I would have not been able to say I didn't know. Thank you, Talon. RL, hey, brother. Talon. Mr. Pete, welcome. Did I say Sunday night? Sorry. Rough day. Sean. Talon. Good vol and reversal bars on the queue. Great call and going short term. Yeah, so what Talon's referring to is that around lunchtime, I took a look at the chart of triple Qs, and I'm doing Atkins right now, so it wasn't a sandwich. I had rolled up salami and provolone, still very, very good. So I'm looking at the chart, having my lunch, 30-minute chart. Here, let's bring it up. Okay, so I'm looking at this, and I'm saying, wow, look at that. And we had already flashed this outside reversal bar. If you're not familiar with what that is, link below, my 5-part video tutorial, my top 5 favorite candlestick patterns, free. And so I saw this and I says to myself, I think we're going down. And it's probably not going to be a pretty good close. And sure enough, I put the short trade on using a put spread, and bam, got hammered. Hammered. I rarely put trades on intraday, and when I do, I'm usually wrong. I usually regret it by the end of the close. So one of my rules is put your trades on after 3:30. Take them off whenever you want, but put them on after 3:30. That way, there's no shenanigans with the share price. And but this one, I figured this one looks pretty ominous. NVIDIA was ripping up higher, and another stock that I took a look at, and I said, "There's something wrong here." Was SMCI. Now, admittedly, after earnings last night on NVIDIA, I took a look at SMCI to see if I can get a vertical play off of SMCI. Maybe it didn't move all that much yet. So I took a look at the chart and I said, wow, it's kind of strange. We're up, but we faded to about just being a little bit above where we closed out the day. Then I'm continuing to watch it, and all of a sudden it's trading after hours at around 860. And so I said, you know what? I'm going to put an offer in at 860. I didn't get filled because it just shot right up. As soon as I put that order in, shot right up. I said, you know what? I'll wait. I'll see how it plays out, because it bothered me that SMCI, which had a really great daily setup going into NVIDIA earnings, was not following through, although it did recover nicely. And it opened up today very, very nicely. The however is bearish key reversal bar. We faded on the day. I mean, look at this. Look at that. That's horrific. So when I saw this, and obviously it wasn't this bad when I put the trade on the Qs, I remembered the fade after hours last night, and I was like, aha, that was a tell. That was a tell that there was something wrong out there. The price action on SMCI there was something very, very wrong out there. The fact that it was trading down after hours as NVIDIA is surging. Hey, this is a quintessential AI stock, low float. Why wouldn't it be ripping? Ultimately, I was right, but I just said to myself, you know what? Don't chase this thing. There's something wrong out there. So going into NVIDIA earnings, we had a very, very, very nice move up here on the 15th. Went into a consolidation, closed right at support. I could easily see this being a bull flag setup. And there you have it. But then, I'm not going to save this. We rallied, faded, and we've broken back down again. So this is a major, major tell right now. Top tier stocks are under pressure. Everything is under pressure. NVIDIA, even on the day, closed up strong. Closed up 9 1/3%. But you got a little bit of a wick up there, a little bit of a topping tail. Volume is great. Let's see how they close this. Not a bad close, pretty good close. But the market's rallied back somewhat in the last half hour of trade, because I took a look at the charts prepping for the show. So now getting to the rest of the comments, TZ Burton. No, no, not in the Bronx today. No. Deckers did well. That's DECK, right, Aro? Thank you, sir. Franklin, welcome. All right. Trailing PE ratio, S&P 500, 34.47%. Now, here's where it really gets wonky, the Buffett indicator. We are 197% stock market valuation relative to the GDP of the United States of America. So in short, and I went over this last Sunday, that we were at the 2 standard deviation mark on the Buffett indicator. We generally do not spend all too much time up here. We rarely visit it. We visited it back in 2021, prior to that, 2000, prior to that, 1968. So the frequency at which that we're seeing this occur is picking up. The problem is it's unsustainable. Now, when I do market wrap, I go through a series of charts, same charts every single day that are the baseline we must look at for us to have a proper pulse check of the market. So I send that out to members. And one of those charts, two of those charts, I should say, is the Dow Jones Industrial Average and the Dow Jones. Why? The Dow theory. Now, JC Parents tweeted this out earlier, and it's not something that we were unaware of, but I'm glad that the word is getting out. The divergence is still nasty, and no one seems to care. He's spot on. He's spot on here. I agree with him 1,000%. We've been talking about this, that you have the Dow Jones transports breaking down. In fact, the Dow Jones transportation sector peaked out technically back here in November of 2021. Lower high, peak the summer of last year, July, almost a year ago now. And now we're breaking down. So this is either the mother of all bases from which to break out of, or the mother of all rounding tops on the Dow Jones Transportation Index. I'm not making the call. We're just using this right now as a moment of saying, okay, there is a very, very serious divergence going on here. And as JC points out, nobody seems to care. Nobody's paying attention to it. You're not going to hear about it on CNBC. You're not going to hear about it on Fox News. You hear about it here. My members and I have been talking about this for a couple of weeks now. So here's the Dow Jones Industrial Average, and it is in fuego still. And the exact opposite is true for the Dow Transports. Now, when we take a look at a daily chart, things began to correlate again. Dow Jones rolled over, as did the Dow Transports. Dow Transports are sick. I think we still have FedEx numbers that come out either next week or the following week, and that really wraps up earnings season along with Adobe. Now, it also is killing the market and making the sell-off broad-based is the dollar. I mean, it's kind of counterintuitive. You wonder, why would the U.S. dollar being so strong hurt the stock market? The reason is that a stronger U.S. dollar makes our goods more costly overseas. So other countries with a weaker currency, they need to go out, borrow dollars to buy our goods. So they need to turn in their yen for dollars to buy our goods. And it's expensive. And it looks as though the dollar is getting ready to break out. This is a weekly chart, no less. So not insignificant. Now, I had been hoping for a rally in the yen in anticipation of more Bank of Japan intervention, but that setup could be failing right now. We stopped going down. We haven't broken support. We could still be putting in a higher low here, but it's not looking good. Let's go to a daily view. You need to have the euro and yen rallying together. Down volume rose today on the yen. Not good. FXC is the euro ETF. That was down today. Bearish, key reversal, outside reversal bar, bearish engulfing, whatever you want to call it cupcakes. This is a very, very bearish chart. So the dollar looks poised to move up higher unless, of course, this is negated as soon as tomorrow. What else is going on out there? Look no further than the 10-year yield. We're breaking out. And there should really be no surprise that it is. And we've gone over this before. Yearly chart. The yearly chart, we are very close to taking out the highs of 2023. This is a yearly breakout. We had been in a bond bear market, bull market, I should say, bull market, and a yield bear market for 30 odd years. That's over now. That's in the rearview mirror. We're third world right now. Our interest rates are going up, not down. And it looks as though today the market's got the message. The problem is that this may get worse. The strength of the dollar may only be temporary. I said it back in 2022 when we weaponized the U.S. dollar against the Russians, seized their assets, froze their collateral, not collateral, their assets here, and we screwed them. We weaponized the dollar, banned them from the SWIFT system, and we just told them, the world, we said to the world, don't trust us. You do something slightly wrong, we will weaponize the dollar against you. And the Chinese heard loud and clear. And the Chinese have been de-dollarizing for years now, even before the Russians invaded Ukraine. They have been de-dollarizing. And this is pretty good to credit out to Jesse Felder. He puts out some good stuff off of Visual Capitalist. Let me see if I can blow this up. Yeah, that's better. So here's the gradual move. This is in yellow is the renminbi. That is their offshore currency. Onshore, I believe, is the what's the yuan? So share of China's cross-border payments and receipts in U.S. dollars. Since 2016, actually they peaked back here in around 2011. Now they have inverted. They're making more payments in renminbi than they are in U.S. dollars. This is the second largest. Technically, it is the largest economy in the world in terms of production. We're larger, but that's in dollar value. In output, they are larger. And per capita wealth, we're still wealthier. But this is a problem. This is a problem. This is also a problem. I don't know what global press is. I don't know if it's a reputable source, but I saw it as a tweet, and sources say China will invade Taiwan in early June. I don't know how they know that, but as of now, the Chinese military, they are conducting massive military drills, far larger than what they were conducting when Nancy Pelosi went over there with a surprise visit and the Chinese launched drills. This is far larger. As of now, the Chinese military have begun drills surrounding the entirety of Taiwan, including islands of Kinmen and Dongjin, state media says. This would be World War III. World War III. So we have our catalysts out there. And if the dollar continues to be used less and less, when the time comes for the Federal Reserve to print more money, and they will, they're going to cut more. They need a crisis. They need to create a crisis and then come to the aid of the market. They've already claimed victory over inflation, even though it's never met their target. It's come down some, but they'll claim victory. Then the next crisis is going to hit, whether it's going to be the bird flu, China this, Russia that, Ukraine this, doesn't matter. They'll create the crisis, and then they're going to address it. And that means more money printing, guaranteed. It is coming. But they need the crisis. They can't do it with an anticipated GDP of 4%. Can't happen. So other things that are out there that are disturbing, to say the least, for the economy. Supposedly our GDP is still going up like a jet plane. All is well. Nothing is wrong out there. There's a problem. There's a problem out there. It's this. And nobody talks about this report. This is the U6 unemployment rate. So the headline number, also known as the U3 number, that's what they feed us, the U3 number. If you're not looking for a job anymore, they don't consider you in that number. You're not calculated in. You just drop out of the workforce. You do not exist. However, there is a phantom workforce out there, and it's reflected in the U6 number. So let's take a look at what's going on here. So in gray, you have the official number, and you can see how it's been flatlined, and now it's grinding up slightly, not a big deal. Here's the U6 in blue. It's on a tear. Real unemployment in the United States right now is at around 7.3%, not this ridiculous number that they keep flouting out there of 3.8. The numbers we're being fed are bogus. Now, when you take a look at earnings out of the S&P 500, anybody see the problem here? Supposedly, this is the greatest economy in the world that we've ever seen in history, yet earnings peaked out in April, the April quarter of 2022. Not only that, we have broken down below the lower band of support, and we are now at a ceiling on earnings. That means without a correction, stocks only get more strongly overvalued. If GDP misses, stocks become more overvalued. Stocks need to correct. Think about Warren Buffett. He's sitting on a hoard of cash. He's sold a lot of stock, including Apple stock. Bezos sold a lot of Amazon. Zuckerberg sold a lot of Facebook. And what's not changing? They want you to believe that inflation is done. It's gone away. We won. Wave the white flag, inflation. You're done. The problem is that there's still way too much money out there, and they're doing transactions. You have credit card debt, which is through the roof, mind-bogglingly through the roof, and delinquencies are rising, but not at crisis levels yet. So this is the velocity of money. Basically, it's how many times the dollar changes hands in an X amount of time. So if you have a lot of transactions, that dollar flipping over, meaning people aren't saving money. Well, that means that goods are in demand. And you've seen that ever since the stimmy tax checks went out. For the longest time, we had inflation that was negligible, really muted for years, decades. That's because the velocity of money was tanking. People were saving. Now, that genie's out of the bottle. So the only way you solve this is not by rate cuts, it's by rate hikes. And also, unfortunately, if unemployment rises. Did you know that single-family home sales peaked in 2005? Yes, that was the great financial crisis just before it, a couple of years before it. We have never recovered, and we're putting in a lower high. This is a quarterly chart, single-family homes. Copper, it's pulled back this month, but still on the month up over 6%. Coffee, this is just a monthly chart, not a yearly chart. Look at this tear, up 1.75%. Corn, breaking out. Wheat, breaking out. Look at this breakout on wheat. Soybeans, breaking out. Yield curve, what's that doing? Is this updated yet? I know it's flat. Yeah, so right now, our only saving grace for this market is that the yield curve is not steepening. Couple of trading days left to go here, but it's not steepening. If this was breaking out right now, I'd be shorting the market hand over fist. $634. Let's take a look at some charts of the equity markets, and then we'll do some chart requests. Franklin, what type of reduction are you looking for in the market percentage-wise? You know, if we do not get a yield curve steepening, I think that we could get but it's hard to make a percentage call. 5-10% pullback. That all changes if we break out on the yield curve. If the yield curve starts steepening, and we break out above this upper band of resistance, that's a game changer. At that point in time, that means that we are in crisis mode. Any movement by the Federal Reserve will be viewed as too little, too late. Equities will sell off. This is why whenever the Federal Reserve cuts rates, stocks go down. They may go up that day, but then they drop like a rock immediately thereafter because it's not enough. The market's saying it's not enough. And then they come out with their Sunday 50 basis point rate cuts, emergency rate cuts, blah, 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 blah. They'll be down to zero again in a heartbeat. So while we think that the Federal Reserve is tightening up their balance sheet, and they are going to inflate that sucker 6 ways from Sunday once the crisis gets going. And we do have a presidential election coming up, and doesn't matter who's running, Democrat, Republican, the Federal Reserve always comes to the aid of the incumbent president. Always. So to answer your question, with the Buffett indicator being our benchmark, if we see in each one of these cases, the yield curve steepened, causing a major sell-off. 2000, stocks weren't as expensive in 2005, but they were certainly expensive in 2021. So what's the mean? You could be looking at a 50% haircut on this market. The current ratio of 197 is approximately 60.88%, or about 2 standard deviations above the historical trend line, suggesting the stock market is strongly overvalued. Now, in each one of these instances where we blew past, with the exception of 2021, where we blew past the 2 standard deviation Bollinger Band, we've retraced all the way down to below a 1 standard deviation. So you're looking at a 50% haircut on this market, S&P 500. That's how bad it could be. Bitcoin dropped today after its run higher. Yes. I still like gold, Corey. The problem is, we'll go over the chart of gold in a moment. The problem is that the dollar is threatening a breakout. If we get geopolitical risk, if this China-Taiwan issue is firming up to become something, then you're going to see gold and the dollar rally together. Absent that, it's going to be very, very difficult for gold to rally with the US dollar. Now, that being said, gold in euro terms, in yen terms, in Canadian dollar terms, it'll still go up. The problem is for us is that the gold is priced in US dollars, and that causes it to go down in dollar terms. You're welcome, Franklin. Anytime. All right, so that's the yield curve. We went over yields. We went over, well, Bitcoin we didn't go over. Bitcoin's still up 2%. This breakout's under pressure. TLT, we did. Tips, bearish reversal bar. Dollar, we did. Euro, yen, we did. Volatility. Okay, so volatility, bullish reversal bar. Not a bullish key reversal bar because we're not at the highs of the week, but clearly this descending wedge formation has gotten really, really old. And this has got to get resolved. I think it gets resolved up. Transports, we did. Dow, we did. S&P 500 weekly view, bearish, key reversal. 1 trading day left to go. It's going to be a very, very light trading day tomorrow, folks. A 3-day weekend. You may get some short covering ahead of the weekend, but we will maintain our short position. Let's go to the daily view, see how much damage is done here. Bullish, bearish engulfing, momentum rolling over. Volume light. You know, it rose, but this has been the story. You know, we got to be fair. We talk about how weak the bullish rally is with no volume, but to be honest, you know, a move like today, you know, down almost 0.75%, yet we're not even at the moving average. So it's not really a lot of institutional selling. There's not a lot of institutional buying. There's not a lot of institutional selling. A weekly chart of the Qs, still up nearly a 0.5 percentage point, but volume. There's no volume. How many weeks is this? It's like 6 weeks. 1, 2, 3, 4, 6 weeks. And here's the volume. Lower and lower. And we're heading towards summer. Volume's only going to lighten up from here. Daily chart. Now, we've been watching this very, very carefully, this ascending wedge formation. And we knew that this is why I didn't cover my shorts. We covered a portion of the SQQQ. That's a short product. I kept about 1/3 of the position, and we added more today. So not aggressively. Because I think what's going to happen here is that we're going to rally and try to recapture 460. They're going to try to recapture this prior lower band of support. Volume today. This is the first average volume day since May the 3rd. Think about it. Let's see how they close this day out. 30-minute chart. You know, they rallied it, but this could easily roll over. Good volume at the close. Semis, led by NVDA, still up 4% on the week. New all-time highs this week. LABU, biotechs destroyed today. Let's take a look at the daily chart. So small caps got annihilated today. Why did the small caps get annihilated today? Remember what the small cap basket is made up of: biotechs, regional banks, predominantly. All right. So here are biotechs. This is a leveraged product. So, take that percentage loss on the day, divide that by 3. Still a respectable down day. So down about, let's call it 3.33% on the day. So that's stool leg number one taken out from underneath the small caps. Then you get this KRE, the regional bank index, that was down 2.5% on the day. And this is another one that was performing well only a few days ago. Now, no bueno. Now, this chart here, I mentioned earlier, we are now down 2.7% on the week. Take note of this relative weakness here. The loss of momentum is profound. This is the consumer discretionary ETF. Lower highs. We break 170 and close there, it's going to be Armageddon for the discretionary names. Also, let's illustrate. This is really what I wanted to do, was this. My two favorite momentums are validating each other: RSI and the slow Stokes. Lower highs, lower lows, and weakening. I think that this sector is toast. And the reason for that attitude, besides the weekly chart, is that yesterday, actually the day before yesterday, we had this beautiful, beautiful bullish engulfing, and it failed. No follow through. When you see a setup like that, and it just doesn't go, and it should, that's a warning flag on the track for at least that sector, if not a broader problem. And when I take a look at this chart, I don't just think about the chart. I think about it in the back of my head. Okay, auto loans are through the roof. The delinquencies are through the roof. Repos are through the roof. Credit card debt is sky high. The consumer has no more savings. Delinquencies on said credit cards are rising. And buy now, pay later, or as I should call it, buy now, pay never, is the last crutch for the consumer. Emerging markets, avoid right now, dollar too strong. Energy, another tell here. We actually broke out the week before last, continuation breakout last week. This week, bearish engulfing. There's one trading day left to go, but this is going to take a miracle to recover from. Daily chart. Look at this. This is in the books. We broke out, failed. That's a breakout point failure. At a bare minimum, we're coming down here to about $90 a share, because that represents the lower band of the downtrend channel. Many times you just simply cut right through that support level. Actually, I'm going to update that. We're going down to 89 on XLE. Oil. I bought some oil contracts, futures contracts, earlier in the week, and I was up, and I saw a breakout setting up, and I said, "Wow, this should be a really good breakout." And I thought for sure those future contracts were going to take off. All of a sudden, we do a reversal bar. A few minutes later, I'm flat on the position. I said, "You know what? I'm not letting this turn into a loss. There's something wrong." Because in the back of my mind, I'm thinking, what's going on with the transports? Transports are breaking down. If you don't have transports, why do you need oil? And initially, I'm thinking it's probably because Biden is releasing oil and gasoline out of the SPR. But this type of weakness combined with the Dow transports is a major concern. So oil coming in under a lot of pressure. Both lines on Stokes, trading down below 50. Rallies tend to fade. What happened? The rally we saw last week, and we had a continuation move this week, faded. I do not buy stocks, commodities, cupcakes, whatever. If stochastics are trading down below 50 and declining, if they're flatlining and moving back up, okay, then we revisit. Not until then. We're a long way. We're weeks away from that. Natural gas, very powerful week. Still up. This is Boyle leverage product. I don't know if it's 2 times or 3 times, but it's a leverage product up nearly 10%. We can look at UNG. UNG up nearly 5.33% on the week. That, however, is we're flashing a big, big topping tail, daily chart. Bearish key reversal. So it looks like Natty Gas is going to pull in here. I'd be a seller of call spreads here. Let a pullback occur, then sell some put spreads. But I would try to get to as close down here to sell those puts as possible, because they call natural gas the widowmaker for a reason. It'll kill you. So you got to stay small in that trade. Very, very volatile. Gasoline prices. Transport's pulling in. What do you need gasoline for? Consumers dead. Gold. We are now down 3.33%. We put in new all-time record highs, and now what we have is a double top. Now, what we're looking for is for gold to probably break support if the dollar breaks out. If the dollar is doing a head fake and we get a bid on Sunday night when futures markets, I don't believe are open on Sunday because Memorial Day. Monday night. Yeah, Monday night they'll be open. So when the futures markets open up on Monday night, and if they bid yen, they bid euro at the same time, dollar will be pulling back. That'll help salvage gold. If the dollar breaks out, it's going to be very, very tough for gold it's not going to move higher unless there's geopolitical risk. At best, it'll tread water. Gold mining stocks you want to avoid completely. They're going to get clobbered. Again, absent geopolitical risk. The only reason why you've seen this rally in gold, the gold mining stocks, silver, etc., the only reason why you've seen that correlate with the U.S. dollar is because you have all the shenanigans going on in the Middle East, Gaza, the Israeli conflict. So that has allowed for gold and the dollar to rally together. I should say Iran in there, they're lobbing missiles at each other. But that's over now. As far as Wall Street is concerned, let's take a look at the daily chart. Yeah, pretty brutal. So where might we be going? I think we have further to drop. And if we break down below 22.85 and close there, we could be going a lot lower on gold, because that would be a confirmation breakdown. I'm not predicting it. I'm not predicting that. I'm just saying if we do. Gold mining stocks, bearish reversal bar on the week, down 5.33%. This is a leveraged product, 2 times leveraged product of the senior miners, down 11.28%. You want to take a look at the seniors as a standalone. GDXJ down 5.7% on the week, bearish engulfing. Silver down 9% on the week. Silver miners down nearly 5%. And this is a classic example of what took 1, 2, 3 days to take away, to give. Only took 3 days to take away. And I think that we are going lower here on the gold mining stocks. I think it's going to be a buying opportunity, but you got to keep an eye on that dollar. Sorry to keep harping at that, but it's so true. All right, let's do some chart requests and we'll call it a night. Okay. All right. We did the video already. That one we don't need to do. Let's do Netflix. If you have any requests, I have a couple of minutes left, so drop them in there. I'm just checking the members area. 1795. Make sure I didn't forget anybody. All right. We have GM, Apple. Okay. Netflix first. Monthly chart Netflix. Really, really pretty stuff. We're at quarterly resistance. This is Trend Spider, automated technical analysis. We are at quarterly support. If you're wondering, how does he know that we're at quarterly support on a monthly chart? Simple. This is the overlay of a quarterly support and resistance on a monthly chart in dashed line. So do we break out? Maybe, but I wouldn't be a buyer here. We're at quarterly resistance. We do have a monthly breakout, but we still have several trading days left to go. Weekly view. Earnings are rising. It's reflecting the quarterly resistance here. Me, I'd be a call seller here. Call spread up at around. Ooh. If you can get any good premium up at around 700, going at around 45 days, I would look at that because you have monthly resistance up there. Daily chart. So not a horrible day today. It was down, but it held support at this volume shelf at 630. So I think that this could still move up higher if the overall market participates. So again, I think that we're going to do, going back to the Qs for a moment, I think we're going to do a check back, right? Because what we did today is we broke support. We broke trend. What they do is they generally rally it back and they try to do a retest, try to recapture it. And that's when shorts like me lean in. We lean in. We see that. It's like, good stuff. And most of the time, you break. So just be careful. Apple. Earnings decelerating. Oh, revenues decelerating, I should say. Got to avoid it. Bearish reversal bar, off the resistance, weekly chart, daily view. Broke support today. Apple is a laggard. I wouldn't want to be a part of it. And we will Crocs. I haven't looked at this one in a while. Crocs. Weekly chart. Not bad. At resistance, but good stock. Nice breakout here. There's more upside to be had here on Crocs. Daily chart. Consolidating. I like it. Let's leave off with one more. Take care, Sean. Have a good night, pal. One more. ABNB. Disaffected Canadian. Yeah. This stock is in trouble. All you see all over Instagram are the squatters moving in on these properties. They have more rights than the owners. Airbnb, bearish key reversal bar on the month. I think that in June, we are probably going to rally up to 145 per share, and then we're probably going to fail and move lower. So I'm not ready to short this quite yet, but soon. It wants to go lower. It's very, very weak. So from a short perspective, what would I do? I would look for a rally. Right now, we're breaking down below the lower band of a descending wedge formation daily time frame. So this can happen. A descending wedge does not always resolve itself in a breakout. It can get resolved to the downside with some parabolic selling. Then all of a sudden, you're going to get a rip your face off short covering rally. And that could take you up to 145. If we fail to recapture 145 and close there, I would be looking to short it at that level and opening position short. Then I would add to it as we break down to new lower lows. And that's it, folks. Have an awesome remainder of your evening and have a profitable trading day tomorrow. Enjoy the long weekend, and hopefully I'll catch you on Monday Night Futures Live. No Sunday Night Futures Live because it's a holiday weekend. Monday Night Futures Live. I'll catch you there. Have a great night. Be well.